Welcome to the Limitless Podcast, where we help you break free from financial restraints and build the life you deserve. If you're ready to escape the 9-to-5, create financial freedom, and take control of your future, you're in the right place. Each week, we dive into real strategies, expert insights, and inspiring stories from those who have achieved financial freedom, so you can too. Welcome to today's show.
Okay, hello everyone for another episode of the Limitless Podcast. Excited to have Barry Brooksby on the call. Barry, hello.
Hey, Shawn, how you doing?
I'm doing well, sir. It's good to finally have you on. I know you actually are our life insurance agent, and for a very specialized type of life insurance, which I know we're going to dive into in this call.
Yeah, don't say that. Don't say that too loud. You'll scare people away, right?
That's right. Well, I'm just using the industry term, if you will, but yeah, no, Barry, I think we've known each other for I forget where we met, but it's been what, 5-6 years, if not longer. It's been a minute. Yeah.
And I've watched you grow and be successful. It's been pretty cool.
No, thanks, Barry. And we share a love of real estate, which I'm sure we'll touch on here, but we come from different backgrounds. And I think one thing I love about your background, Barry, is you started in the stocks and equities markets in Wall Street and all that. And you sort of arrived where you are today from all that. So different, I came from the tech world, got into real estate, but you have, kind of a different journey here. But I just read your book and I see that in your background there, but Live Rich, Die Rich. Yeah. Great book. And I think every American should really read it. That's my plug right there for you, Barry. But really powerful stuff. You're talking about a lot of very important concepts, things like infinite banking, which I think a lot of folks are like, what's that? Right? Never heard of it, but it sounds cool, right? So I'd love to touch on that. You talk about in your book, you talk about real estate versus stocks, right? Which is one of the biggest questions that I come across as a real estate investment fund manager. You talk about different policies of the IRS tax code and how it's key to your overall wealth planning and your overall strategy as far as how you're looking at your financial picture. You talk about Dave Ramsey and how he's wrong about life insurance. So, love to talk about that too, how the traditional 401k might be a scam, which is crazy because, I come from Microsoft and I know so many people who have 90%, if not 100% of their portfolio is stuck in their 401k and in their Microsoft ESPP or stock plan, but yeah, tons of places we can go today, Barry. So I'm excited, but I guess let me start with, tell us what you do today with your business and also, how you got here. What was that evolution for you?
Yeah. My main focus today, I work with clients all over the country. I've done this for 25 years. Primarily the two goals I have: number one, to help people create more wealth, and two, pay the least amount of tax possible. So what I do is a lot of tax-free planning, and I'll get into more of those details. But how I got here, I watched my parents invest in real estate. They would buy a vacant lot, they'd build a spec home, and they did this over and over again. So internally, I had this investment bug. And 27 years ago, I got securities licensed. I'm a guitar player. I was teaching guitar at one of the local universities in Utah. I was the director of the guitar program, and my summers would slow down. So I went to my mentor buddy and he said, "Hey, why don't you get licensed in financial services?" I was like, "Oh, I like investing. I want to do that. I want to be an investor." That sounded cool. So I did that. I pursued the path and I started putting my own money in the market, my clients' money in the market. And a year or two went by and I would get these calls, Shawn, from clients, and they would say, "Barry, why am I not making money, or why am I losing money?" And I had no idea what to tell them. I was so new in the business. I went back to my mentor. I said, "Hey, what do I tell my clients?"
Yeah.
And his answer was the same over and over again. He said, "Barry, tell your clients they're in it for the long haul."
Oh.
And consciously, subconsciously, they just didn't sit well with me. I'm losing sleep at night. My clients are losing sleep at night. I'm still getting the phone calls about, where's my money? Why is it not growing? And to tell them, "Hey, remember, you're in it for the long haul," it just didn't sit right. So I
Yeah.
began this journey of there's got to be something better out there, because as Americans, we're all trained, we're all coached, we're all educated. Put your own money in the market, right? 401ks and IRAs. And I'm not saying don't ever do that. What I am saying though is if the majority of your money is there, you're going to have a serious problem in the future, which we'll talk about. But what I discovered in that journey was real estate investing and high cash value, properly structured insurance, specifically designed for infinite banking. So that's what I do today. Real estate investor. I have multiple infinite banking policies, and then I teach and coach these ideas and these principles to clients all over the country.
Amazing. Amazing. And Barry, I know you hate me using the term life insurance, but from a layman's perspective, you're in this world of life insurance and you have a highly specialized version of it, if you will. And folks like Dave Ramsey, wrongly sort of lump you in with the rest of them. But can you explain, the difference between the different variations of life insurance policies out there and how you're actually turning life insurance from being just this sort of thing you pay for and sort of forget about and hopefully never use, right? Which, to actually a asset to your overall financial strategy.
Yeah. And Shawn, I have had clients pass away, just 2 in the last 4 months. And these were young people,
Wow.
in their 30s and 40s. So
Wow.
that does happen. But life insurance is called life insurance. It's not called death insurance. It's called life insurance. And
Right.
what I do is I teach people how to use their life insurance while they're alive. Primarily, people are going to be familiar with term insurance. You buy a policy for 20 years. It's going to cover you. If you die within that 20 years, your family's going to get a death benefit. But statistically speaking, and your listeners probably aren't aware of this, but less than 2% of term insurance policies ever pay a death benefit.
Less than 2%. Wow.
Less than 2%. So 98% of people that have a term insurance policy, they're going to pay for it for 10, 20, 30 years, but they're going to outlive it. Term insurance is like renting a house. You rent the house, you leave the house, there's nothing to show for it. You have no equity. The other type of insurance is permanent insurance, and I use whole life insurance specifically. Whole life insurance is like ownership. It's like owning a home. You're building equity. The difference in what I do, the reason my business, my company is very niche, is because we're not focused on the life insurance component. The key is minimize that life insurance cost. We want that to be as low as possible and maximize the cash value growth. So within a whole life policy, if it's properly structured and set up and designed the right way, there's a savings component of cash value within the policy. And people might say, well, why would I want to save money in a whole life insurance policy? Here's why. 3 main reasons. Number 1, it's guaranteed. You make returns every single year, so you're growing money on this amazing compound growth curve. 2,
Right. Well,
yeah, the cash is liquid. You're not locking up your money till you're 59 and a half like you do in a 401k or IRA. So you or me, we've got policies. We can take policy loans 30 days after we start the policy and boom, invest it in real estate if we want to. And 3, this is my favorite, so everyone's ears can perk up.
Yep.
The money and the gains you're able to use 100% tax-free. So
amazing.
there, many more benefits other than these 3, but these are the 3 top benefits. So I love it because it enhances a portfolio. It gives someone an asset in their portfolio that's guaranteed, liquid, and tax-free. And then someone can fund it however they want. I've got clients that are putting $1,000 a month into a policy. I've got clients that are putting in $500,000 plus a year into policies. Those amounts are up to you, but I love to see people getting these benefits because frankly, Shawn, they're not getting these benefits in the investments.
Yeah. How come more of us, it's funny. I remember back when I graduated from undergrad, my roommate became a life insurance agent or broker with, I think it was Northwestern Mutual at the time. And, he was telling all his friends and family members all about it because he was obviously making some commissions on these sales and everything. And I signed up for a whole life policy, and he sold me on the whole, this is gonna be, like you said, it's like owning a house. But then I remember, canceling that policy years later, and fortunately I maintained the friendship, but cancel the policy because I realized my break even point was like year 7 or year 8. And I'm like, I could be putting this money into real estate or something and getting a far better return. So that didn't really strike me as a great investment. But then you and I met, a few years ago, and you showed me this high cash value version of it, if you will, where it's much different from your standard retail whole life policy. Explain that difference.
Yeah.
For our audience
Most
too.
life insurance agents out there are going to sell you just a traditional old style whole life policy where the policy is focused on death benefit. So you don't have cash value early on. Like you said, your break even point is 8 years or later. I mean, I've seen break even points 20, 25 years later. It's crazy.
Wow.
Yeah. But it's because one, they don't know any better. That's just how they've been trained. But two, there is a special way to design these policies with, and I'm not going to get into the weeds, but there's a writer we use called PUA. It's paid up additions. When you use a paid up additions writer, guess what happens? The insurance agent's commission dramatically reduces. So even agents that know about PUA, they don't want to use it because it
Right.
reduces commissions.
It affects their pocketbook. Yeah.
Yeah, that's right. Not as much money is going into the life insurance component. But frankly, it's better to use PUA because now you're giving a client a much better policy, higher cash value growth, and earlier break even point. And I've had clients say to me, Shawn, well, Barry, why do you do this? If you're reducing your commissions, why do you do this?
Fair question.
For one, and I have multiple policies myself, but I know it's the right thing to do. I mean, just it's the right thing to do. And I've got a good reputation out there, so I make it up in volume. Repeat business, referrals. I've got clients all over the country. So when you do the right thing for people, I believe you reap what you sow, right? Karma, what comes around,
100%.
all those things. So it is the right thing to do. And I'll often say to someone, look at your own numbers, because when you hear guys like Dave Ramsey talking about whole life insurance, to me, I feel like I'm talking to a third grader. He's very blanket statement oriented. And some of the things he says, they're not only misleading, they're just flat out not true. So don't get your whole life insurance advice from Dave Ramsey. He's good about paying off debt and things of that nature. But when you consider properly structured whole life, you really want to look at your own numbers and then how this can be an asset in your own portfolio.
Yeah. That was great, Barry. And I've got, as we have discussed offline, we're looking to start whole life policies for our 4 children. They're 3, 5, 7, and 9 right now, age wise. So you can never start too early. Right. So definitely hear you in terms of doing the right thing. Right. I think it's a good testament to that. And in your book, Barry, you talk about many wealthy people, big companies, big corporations, even, who are investing in this type of insurance. Why aren't more, you mentioned incentives is maybe one reason that life insurance agents don't really, maybe promote this product or this version of it. But how are these, how are wealthy people, ultra high net worth, or perhaps big companies using these policies?
Yeah, they always will insure a person. So for example, take, a bank, Wells Fargo, JP Morgan Chase, US Bank. They own billions of dollars worth of life insurance policies. And you can go right into the FDIC website and see it. It's a line item. But what they do is they'll insure primarily their executives or key people, and the bank owns the policy. Well, they want the same benefits. They want the guarantees. They want the access to the cash. They want the death benefit. When that person passes away, the death benefit doesn't go to their family. It goes to the bank. So it enhances the bottom line assets of the bank. And banks call this tier 1 capital. This is like their foundational capital because it's safe. The mutual insurance companies that I work with, they've all been around for 120 plus years, some 160 plus years, right? So Some of the strongest, if not the strongest companies in the country are mutual life insurance companies. They're not taking risks on people's money. Banks, corporations have these policies because of those benefits, because of those guarantees. But we want mainstream America to have the policies. As I mentioned, 1,000 a month you could put in, but you could put in, hundreds of thousands a year if you want to. And as you're building cash value, it's growing on a compound growth curve that I mentioned. The question might come up, Barry, why haven't I heard of this? Right? What's the reason? Why am I being told by my financial advisor or my HR department, get the 401k, get a brokerage account. Oh, my CPA is telling me to max out all my qualified plans, get the IRA, get the Roth IRA. We're going to save you a ton of money in tax this year. Those planners aren't really looking long-term. They're saying, what can I do for you right now to lower your tax bill?
Right.
But what's interesting is not only do these banks and corporations have these policies, a lot of wealthy have these policies, but inside of the policy, because you're not locking up cash and because you're getting a guaranteed rate of return, you never lose money. You're always making money in the policy. So if I said to someone, hey, I've got an investment for you. I'm not going to tell you what the return is. It's 100% taxable when you take it out. You've got to put up all the money. You take all the risk. You might lose. How many of us would do that for retirement? We'd all say, no way, that's crazy. But what I just described is a market-based investment. Well, why we haven't heard about this is because we do get our education in America from Wall Street. And frankly, the Charles Schwabs, the Fidelities, the Merrill Lynches, the JP Morgan, right? Edward Jones, Ameriprise, all these powerhouse financial institutions, they want your money in the market. They want to hold on to it as long as they can. And if you ever do ask for it back, they want to give it to you as slowly as possible. And why?
Right.
Because they earn fees off of your entire portfolio. Even if you lose money, you could have a 20 or 30% loss in a given year, but all those companies, all the fund managers, all the money managers, and even your own financial advisor, they will still earn the fees on your negative portfolio. To me, it's not fair. It's how the system works. And so they know every dollar that goes into a high cash value whole life policy is a dollar that they are not earning the fees on. But what's crazy is they have these policies behind the scenes.
Crazy. Yeah. That's when I read that in your book, Barry, about how many of these household name companies have these policies on their balance sheet and we just gloss over it, or they call it tier one capital or whatever term they give it, fancy accounting term. I was blown away. You were saying like Wells Fargo and some of the JP Morgan and all these, biggest companies in the world. So, and yeah, that's the very theme of this podcast of Limitless overall is this whole idea of financial freedom and really understanding how the financial system in America works, right? I think we are taught or told it works a certain way. It works if you put 10% of your money in savings every month or whatever, you invest in a 401k faithfully and do match your company's contributions. The system works if you invest X percentage in the stock market through your 401k or whatever. It works, but to your point, I don't think maybe banks and these financial institutions are necessarily evil, but they are businesses. They're looking out for their own self-interests, right? And I think most people, the average American probably somehow has this false sense of altruism, like somehow these companies are supposed to be altruistic. When they forget they're for-profit companies with for-profit shareholders and they need to turn a profit, right? So, and someone's got to pay for that profit, and that's you and me, right? As the American citizen, right? So I love what you're talking about because I think it's, they're against that backdrop and against that context, you're providing this alternative, right? Sort of financial, I guess, kind of strategy all up and explain to us, infinite banking. I've heard the term, I've read the book. This was a couple of years ago when I think I first met you. I was curious and stuff, but explain to our audience, what is infinite banking in layman's terms?
Yeah, Nelson Nash, he wrote a book years and years ago. He's since passed away, but the book was called, or is called, Becoming Your Own Banker.
Right.
And what Nelson discovered when he was tight on cash, that he had this whole life policy. And Walt Disney went through the same thing. Ray Kroc went through the same thing, founder of McDonald's, where they realized, oh, wait, I have this whole life policy. The bank isn't willing to loan me money right now, but I can tap into my cash value insurance policy. And that propelled Nelson to realize that this money is an asset. And here's the most amazing thing. And let's assume you've got $100,000 in cash value.
Right.
And you want to take a $75,000 loan. The loan you can get within 3 to 7 business days. It's a direct deposit, no credit check, no application. They don't care what you use the money for. But when you take that $75,000 loan, they don't physically remove it from the 100,000 cash value. So you're still earning interest and dividends on the 100,000, even though you have a loan. There is some interest that you have to pay back to the insurance company, but I show in several of my videos and my YouTube channel, people could check out, where you still come out ahead because of the compound interest on that 100,000. Well, when Nelson wrote the book, Infinite Banking, he wanted to show people you can be your own bank. And I'm not saying don't ever use a bank. I'm also not saying don't ever invest in a 401k or the stock market. I think it's wise for most people to get a match on their 401k. It's free money. I don't have any of those qualified plans, but I do have a brokerage account. I've got, 10 or 12 individual stocks that I pick myself, but I don't have a qualified plan per se. So Nelson said, there is a way to properly structure a whole life policy where it is a guaranteed investment. You're going to make money. The cash is liquid. And then use that money throughout your life. So what I do personally, I buy real estate. I take policy loans for the down payment portion of the real estate. I'm still getting bank financing. The reason I'm not trying to or wanting to come out of pocket with cash is because if you use cash, it's locked into the property. It's locked into the real estate deal. And that's okay. But there's a better way. And that is if I take a policy loan, I'm now making money in my real estate deal, Shawn, but I'm also still making money on my total cash value in my policy. So same dollars working for me in 2 places at the same time. And I can pay the loans back however I want. The insurance company isn't bugging me every 30 days to make a payment like the bank would be. I've got clients that are real estate investors like yourself. They do rehab and they say, look, Barry, I don't want to make a payment for 12 to 18 months. I've got to rehab the property. I've got to put it on the market, got to find a buyer. It's got to go through escrow, et cetera. Well, they might say, when I sell, I'll just do a balloon payment, pay some interest. Interest rates today, depending on the company, are somewhere between 5 and 7%, which still, very reasonable. Consider what loans are today with banks. So it's a fantastic way to use other people's money. They're collateralizing your cash value, but you really are using and getting a loan from the insurance company. Low rates, you're still making money on your total cash and you can do whatever you want with the money. But the idea is to keep money in motion. I learned long ago, I've done a lot of work with Garrett Gunderson. He wrote a book called What Would the Rockefellers Do? And it's powerful content. And I've learned that, keeping money in motion, we call it the velocity of money, create more wealth. Don't just be sitting on cash under your mattress or in a safe or in a bank account earning, nominal interest. Keep money in motion, and having a policy allows a person to keep the money in motion. I'll share one other thing. I have talked to clients who are real estate investors and they say, Barry, I made a bad decision on my real estate deal. I lost money or whatever. And the reason is because they have a bunch of cash sitting in a bank account, not earning very much interest. And what I'll say to them is, look, if you have that money in a policy and you're earning 5-6% tax free, which is like 8 or 9% in the market, going to be so anxious to go find a real estate deal or make a decision in a bad real estate deal. Be more patient.
Right.
Get with Shawn and find a great real estate deal, right?
Yeah.
So having the money in a policy, I have seen clients not only do better financially, but make better decisions in their investments because they're not so anxious. They know the money's working for them in the policy. When they put it to work, now it's working even more.
Yeah. Well, and that's amazing, Barry. And I think, I don't want to gloss over that, which is, today, for example, in new construction, in ground up development, which is what I personally do, we're paying 10, 11% for these relatively hard money private lending loans, or construction loans rather, over a period of say 12 to 18 months to basically fund these construction projects. And every month we're paying, 1 to 1.5% of that loan amount, right? For that period of time. And what you're saying is basically, as a, if my policy loan would allow it, or if my policy was large enough, I could basically fund the entire rehab or construction budget, perhaps even the land acquisition, out of that same loan or that same policy, and basically pay it off in 12 or 18 months when I sell the finished product.
That's right. And
without paying a monthly interest every single month, which is crazy.
Yeah. A lower rate, and you're still making money on the total cash. You just reminded me of something. And I've had clients do this, even doctors that lease equipment. I'll say to them, don't lease the equipment, or a construction guy that has a bunch of trucks and heavy equipment, etc. I'll say, don't lease it. Take cash from your policy and go buy it outright. But you were going to get the loan. You were going to take the hard,
right.
You were going to do the bridge financing, etc., and pay 12 to 18%. Take your policy loan at 5 or 6% and still pay it back at 12 or 18%. Now you capture that interest yourself, not the third party lender. That's another way to enhance the cash value of your policy. And what we just described, now you are really thinking like your own bank.
Amazing. Paying yourself interest versus the third party.
Because you're going to do it anyway. Yeah.
Yeah. And then what in turn is the life insurance company investing in, like these 120-year-old plus companies that is so solid and stable over the last 100 plus years? What are they in turn going and investing in to provide these dividends?
When you look at their multi-billion-dollar portfolio, it's primarily guaranteed corporate bonds. So they're getting a guarantee, which means they can give us a guarantee. I do want to say this. The best way to buy bonds is through a mutual life insurance company, because they're getting preferred rates. They're not buying bonds like you and I. They're buying bonds in the million, billion-dollar tranches. And they've got bonds that are 10, 20, 30 years old. We're still making money on bonds they probably bought a decade or 2 or 3 ago. And at the end of the year, all the profits, after they pay the employees and pay the death benefits and pay to keep the lights on, the profits come back to us. A mutual insurance company is owned by us, the policy holders. So they'll come back to us. So you not only earn a guaranteed rate of return, you also earn that annual dividend. It's reinvested back into cash value, and all that growth and all those gains come to you tax-free. So very safe. They do some commercial lending. They do have some real estate projects, but primarily guaranteed corporate bonds.
Amazing. And they're returning an average of 6, 7% a year? What's that average?
5 to 7. Yep.
Okay. Amazing.
And that's a tax-free number. I want to emphasize that. Because if you're earning 5 to 7% tax-free, and we compare that to the market, again, it's like a 9, 8, 9, 10, 12% market-based return. It depends on someone's tax bracket, et cetera. But that's also as if you would never lose money in the market. But that doesn't happen. People in the market, they're going to see the portfolio go down 2 to 3 times in a 10-year period. You never see that happen in a properly structured cash value policy. It's only up. It only earns compound growth over time. Yeah.
Amazing. So what do you tell your clients, Barry, in terms of, maybe for those who are open to it or those who ask, how should people look at high cash value insurance, like you're talking about, how should they view that in the context of their retirement planning and their overall financial portfolio? Is it like the main vehicle that you would recommend? Is it to augment their overall picture, or how do you sort of help them conceptualize that?
It's such a great question because what we've been talking about so far is the banking aspect, right? There is another aspect. These policies are multifaceted. So not only is it a banking policy now, it is also setting you up for tax-free retirement income. And I'm doing that with clients all over the country. And I
Yeah.
have multiple policies myself where I'm planning on taking money tax-free, later in life.
Wow. Right.
So the way someone should think about it, it's all personal. It's all subject to someone's goals. From a financial perspective, think about your gross annual income. On the low end, 5% should go in up to, 25%. And whatever you feel comfortable within there. You and I were talking prior, true diversification, because this is a tool that gives someone true diversification. But true diversification is not talking to your financial advisor or CFP and getting more mutual funds. It's not
Right.
a small cap fund and a large cap fund and an international fund. That isn't true
Yeah.
diversification.
That fundamentally, it's the same asset class, right? It's
Same
just
asset class.
yeah.
True diversification is different asset classes. It could be a business you own, could be real estate, crypto. I mean, crypto is making a phenomenal push right now, and I think it's a very viable asset class. I own crypto personally. I recommend everyone own crypto. Cash value insurance, a brokerage account, a 401k, a mutual fund. All these are different asset classes. That's
Yep.
true diversification. Because think about this. If you get to retirement and 100% of your income is coming from two sources, Social Security and your 401k, you could potentially be in a world of hurt because it's taxable. Even Social Security, if you make over like 35 grand a year, it gets added to your income. You got to pay tax on it.
Interesting. Yep.
I love this analogy, Shawn. Imagine 3 circles in your mind, and we're going to assume these circles represent buckets. The first
Sure.
circle is your tax deferred bucket, 401ks, IRAs, brokerage account, or qualified plans. The second circle is taxable money, brokerage accounts, real estate, right? And then the final bucket would be your tax-free bucket. Roth IRAs, there's some things that you have to play right there in order for it to be tax-free. Some municipal bonds, not all municipal bonds, but some municipal bonds, and then life insurance. So here's the question I want all your listeners to think about. And I already know the answer, but which bucket do you like the best?
Well, given tax day was yesterday, I'm guessing the third one.
I think we did this podcast right in the time. Yeah.
You're right. Totally.
Yeah. 100% of people are going to say tax-free. But here's the telling question, which is, well, where's all of your money? Where's the majority of your money? Most people are going to answer tax deferred. What I'm saying is add this as an asset class to your portfolio, not only for more diversification, but it's the tax-free bucket. People want
Right.
tax-free. We don't know what tax rates will be 10, 20, 30 years from now. Why not have a good portion, if not the majority of your assets in the future, come to you tax-free? That's what I help people with.
Yeah. Amazing. Yeah. No, and I love that illustration, Barry, of those 3 buckets. It makes it really easy to sort of conceptualize that. And it's like, duh. Yeah. It's a total no, it's a total no, no brainer. Do you see any, with all the, you hear just in the last, over the weekend, I think, China is threatening now to dump a bunch of US bonds and various things. Curious with all the various headlines out there, do you see any potential upside or downsides for this particular, for high cash value accounts, or for what they invest in as well?
Yeah, I will say all the companies that I use, they've all increased dividends in 2025. So that's a great sign. They're very bullish. They're very optimistic. I do believe that the presidency will hopefully give us some tax breaks, some lower taxes coming up. It's been talked about. We won't know until, it happens for sure, because taxes are kind of a moving target. But I'm very bullish on the life insurance policies. Politicians have these policies. Well,
Right.
banks, corporations, we've talked about that. And think about this from an economic perspective, the government loves life insurance because when someone does pass away, if a death benefit goes to a family, that family isn't going to have to rely on government programs. Or
Right.
even take someone that taps into cash value for maybe long-term care needs. If they wind up in a facility, right? Nursing
Yep.
home or home health care. I mean, I've had clients that's happened to, and that can be very expensive. $12, $15, $20,000 a month for that type
Yep.
of care. So
Yep.
the government is very pro life insurance because it not only doesn't harm or hurt the economy, it actually boosts it. Because you know what most people do with death benefits when they get a family member that's passed away, they go spend the money, right? They're going to take
Right.
care of the funeral and pay off some debt, but ultimately the next generation, kids and grandkids, they go spend the money. They're putting it back into the economy. They're buying new cars, they're buying houses, they're buying toys. So I only see optimism for the future with life insurance. And I remember that there was an article the Wall Street Journal came out with years ago, and the title was "The Tax Shelter of the Rich," and they were talking about life insurance, which is so
Mm.
interesting to see from the Wall Street Journal. But the
Right.
government recognizes there's value here to citizens to have a policy, and I'm optimistic for sure.
Okay. Well, we'll definitely include your contact information, everything, Barry, in the show notes because everyone should open a policy after this podcast. So you've obviously got me convinced, but I think it's a total no brainer. What is I've heard this is a question I've been meaning to ask you, Barry, and I'm glad we're talking today. So I've been hearing about this variation called Indexed Universal Life, or IUL. I'm not sure if it's just an innovation of the same thing, just in a different wrapper, or exactly what it is. But explain to me and to our audience, what is IUL and how is that different from what you're doing with HCB?
I'm glad you're asking the question. It's extremely popular right now. And the reason is because a lot of agents are promoting it. It does pay higher commissions. But here's the thing, Shawn, an IUL, an Indexed Universal Life Policy, when it was built in the 80s, it's relatively new in the world of life insurance. It's only been around since the mid 80s.
Okay.
Every IUL out there was built on the chassis or framework of what's called annual renewable term insurance. In its most simplest form, what that means, as a person gets older, the cost of the insurance goes up. So you might think that you've got a great premium with your IUL right now, but I promise you, when you get into your 60s, 70s, and 80s, that premium won't be sufficient to cover the cost of the death benefit. So that's the first problem, increasing insurance costs. The second major problem are surrender charges. The majority of indexed universal life policies have surrender charges. So if you put in $20,000 a year, you might have $2,000 to $4,000 of that available because of surrender charges. If you put that same amount of money into a properly structured whole life policy, you'll have 16 to 18,000 of that available, right? 70, 90% available. So there are no surrender charges in whole life, and there are no increasing insurance costs with a whole life product. So IUL shifts the risk off of the insurance company and onto the policyholder. Well, we're not buying insurance to take the risk on ourselves, right? I've got homeowners
That's the whole point.
insurance,
Yeah.
car insurance. I want the risk on an insurance company. That's not how an IUL works. The risk is shifted to a policyholder. But I'll tell you, I've analyzed hundreds of IUL illustrations, the actual numbers that an agent would show to their clients. They look sexy. I mean, the bottom line is they look amazing because they're illustrating usually a 6.5% return, but the money's invested to an index tied to the market. They never show the index losing money, but you and I both know, and the listeners know, that's not how the market works. There will be down years. So the illustrations look sexy. They never show the losses. They only show you making money every year. So I say
Yep.
IUL illustrations do have unrealistic returns. If you have an IUL and you're listening, get what's called an in-force illustration. Call the insurance company directly at their 800 number. They'll email it to you. I'd be happy to do an analysis on it. And there are videos, again, on my YouTube channel. You can go through, I go through real life IUL illustrations and show people these problems I've mentioned. Do I recommend never having IUL? I think there might be some instances where it's possible, but very rarely, because most agents are not structuring them correctly. And you've got to deal with the problems I'm talking about.
Yeah. Well, and yeah, I guess anytime you hear a bank or a financial institution harping something as the latest and greatest thing, you should probably check twice, right? And just
Check twice, do your due diligence.
Yeah.
And there are ways to replace those. There are ways to maybe enhance if someone really, really wants an IUL, because I can sell them. I just prefer not to. I want people to sleep well at night. I never want someone thinking, well, Barry said that I might have to pay more premiums in the future, or I see here in the illustration that my cash value and death benefit could go to zero someday. I don't want that. I don't want my clients to deal with that or the worry of that. Part of financial planning, like truly proper financial planning, a person should be able to sleep well at night.
Yeah.
But that's rare. I mean, it's just very rare. So I like to do what's right for clients, and I want them sleeping well, but I want to sleep well at night too.
Totally, 100%. And that's why I think you've been in business a long time, Barry. How long has your company been around?
25 years.
25 years. Wow. Amazing. Yeah, that's a great testament. What are, I guess, Barry, if there's what would you recommend as sort of I don't know how to best phrase a question, but kind of the average sort of use case. So if someone came to you and said, hey, Barry, I want to start one of these policies today, or after watching this show, right? What would you recommend as sort of like a minimum amount to put into it? And what would that turn into, say, and I don't know, like if you can give us sort of an average picture of what that recipe might look like for the average individual.
Yeah. And again, this is very specific, right? We want to drill down on someone's goals because it's age specific, it's income specific, it's health specific. But let's just keep a very simple example of $1,000 a month, $12,000 a year on a 35-year-old or a 40-year-old. As that money is going into the policy, that $12,000, the first year cash value is going to be somewhere between $8,000 and $9,000, maybe a little more, maybe $9,500. And then every year, the cash value continues to grow. And you mentioned earlier on in the podcast that the break-even point for you was longer than you wanted it to be. Well, we want to get the break-even point as soon as possible, year 3, year 4, year 5, whatever that looks like. But then from that point on, that same $12,000 a year might grow 14 grand, then it might grow 16 grand, then it might grow 20 grand, then it might grow 22 grand. So every year, because of the compounding interest and then the annual dividend that you're earning, you're making more money from one year to the next. And that's what I want people to really walk away with. It's not volatile. You'll hear a financial advisor talk about compound interest. Oh, you're going to get compound interest in this investment. The only way to get compound interest is when you have a guarantee. Because look, if you're investing in, say, a dividend paying stock and you're reinvesting those dividends and the stock goes down in value, you can lose those dividends you reinvested, right?
Yep.
And if it goes down in value, you've just destroyed all your compounding. So the compound interest is always going up in a guaranteed product like this policy. I tell someone, look at your overall income. Take 5 to 25%, whatever you're comfortable with, and let's look at your numbers to put into a policy. So $100,000 a year, 5% is going to be roughly $5,000 a year. You put in 25%, it's going to be $25,000 a year. Or if you want to do somewhere in between. Here's another cool thing. These premiums, like IUL, are flexible. You'll hear IUL agents, oh, the premiums are flexible in your IUL. Well, they are too in a properly structured whole life policy. So that
Sure.
7,000 a month example that I gave, if you ever needed to reduce down to your minimum of like 200 a month, you could. You're not locking in to pay a premium for the rest of your life. Like Shawn, on your policy, when you're ready to
Yep.
be done working, 60s, whatever it might look like, and you want to stop funding, stop. You don't have to keep funding it, but check this out. Even after you're done funding, your cash value is still going to grow every
It
year.
grows. Yeah.
Yeah.
Yep. Yeah. And I think there was a time, I think in 2018, 19, when I was let go for Microsoft, right? I remember giving you a call and being like, hey, Barry, we need to pause those premiums because my income just went to zero. So, and then we picked right back up, right? I think a few months later, I gave you another call and there we went. So yeah, I could totally vouch to that. Couple, this has been a great conversation, Barry. And I think you're a library of information. I think you have a very rich background and, history, and you've been doing this a while. So I think we could have a couple more episodes. I'd love to have you back on the podcast, but a couple fire round questions. Your favorite book. It could be financial, non-financial, but what's your
Well, I'm
book
going
of
to
all
say
time?
too, yeah, my favorite financial book of all time is Rich Dad, Poor Dad because of financial principles. I read the Bible, but I'm also a huge fan of the Book of Mormon. I'm Christian and love that. But
Awesome.
Robert
Yes.
Kiyosaki, his book is so financially principle rich. Everyone should read that book. And there's a lot of those financial principles in my book, Live Rich, Die Rich as well. Pay yourself first and hold on to as
Yep.
much as you can, right? All those things are really, really valuable that we're not taught in school. So what a great book.
Yeah.
He's done a
Yeah.
phenomenal job.
No, two great choices for sure. And if you had to go back and do it all over again, right? And I don't know, this could be touching on real estate, it could be touching on your career or whatever, Barry. But if you had to go back and do it all over again, what would you have done differently?
I would have taken some more risks,
Mm.
but educated risks. I remember I in my 20s, I had an opportunity to buy a real estate rental property in a college town.
Mm. Right.
And the underwriter, because I already owned some real estate, and the underwriter came back and said, hey, you already own real estate. Your interest rate's going to be a little bit higher. I look back on that and I should have just bitten the bullet. And that's happened several times. I just should have bitten the bullet. Maybe a little more education, look at my cash flow
Sure.
numbers, right, et cetera, et cetera. But I think, what would that property be worth today? I'm 55 now, right? If I bought
Right.
that property in my 20s, what would that be worth today? And all the cash flow that I would have gotten. So I'm not a big fan of uneducated risk, like speculation. And you're like, oh, I don't know, don't do that. The
Yeah.
more you know, the less risk you take. Like, I'm not going to go perform surgery on someone tomorrow because that would be very risky for the person and for me. But the doctor, the surgeon, there is some risk, but it's very nominal because he's got the knowledge, he's got the experience, he's got the expertise, he's got the education. Well, the same thing holds true financially. So
Yep.
don't be afraid to take some risks. Just understand you got to get educated about those, because the more education you have, I believe the less risk you take.
Love it. Yeah. And I think that's, I'm also curious, Barry, why do you think, maybe why we don't take more risks, I guess, and even educate ourselves, like I've been dedicated perhaps to, in the last, I'd say, I grew up in a family that was kind of very, very actually rich dad, poor dad. So I had the poor dad, right? I had the educated parents who loved us and did a great job, provide, like they homeschooled us and all that fun stuff. And really, dedicated themselves to our moral character and everything and spiritual formation, all that fun stuff. But financially budgeting was the sexiest thing that you could do financially, was, live within within your means, right? And spend less than you earn. And I remember constant, just, as far back as I can remember, constant arguments in my household about finances, right? And that's what actually prompted me to think about even this concept of limitless, right? Like, I wondered why we thought so limited in our financial, like my parents seemed to think that, there was a cap on how much you can make, right, per year or per month or whatever. And the way to generate more money was to save more. But then I remember thinking in my probably teenage years, I was like, well, there's actually two answers to that question. The way you can get more money is either by saving more or by actually making more, right? You can also make more. And, and sometimes the thing that's lost, right, is we focus on what we have, like maybe this sort of pie mentality, right? This is the total pie. I can either, I can take this much, or I can try to save more and take and take home a little bit more. But really, the amount of money that we can make in our lifetimes is truly limitless, and that's and investing wisely will help that go even further and faster. And so, I guess the question there for you is, I think to your point about risk, that knowledge sort of opens up these worlds that we don't even know existed, but have been there the entire time. Right. And I guess what is the mindset that you would wish that people that you work with have when it comes to finances and when it comes to their financial futures?
This is so powerful. What you're talking about right now, and you use the word mindset. All of this starts in your mind. And we've heard the phrase, whether you think you can or you can't, you're right. It all is in our mind. It's all possible.
Yep.
It is limitless. And there was another book, Think and Grow Rich, right? Our brain, our habits, our outward actions, everything starts right here in our mind. So we have to shift our thinking. We've got to shift our thinking to think, well, what will it take? That's a question I like to ask. Well, what will it take? I don't want to take no for an answer. Well, what will it take? What will it take for you to earn $1 million, $2 million, $5 million, $10 million a year? And then turn into that person that's going to do it. But it won't happen overnight. The get rich quick schemes, they're schemes. That's what they are. You have to put in the effort. You have to get the education, the reading. Now, I want your listeners to think about this question. What is your number one asset? It's not your home. It's not your 401k. It's you. You're your number one asset. You're the one generating the income. You're the one buying the real estate. You're the one investing. You're the one that owns the business. All these things come from you. You're your number one asset. Why in the world wouldn't you invest over and over and over again into yourself, your number one asset? And this is the education I'm talking about. I spend thousands of dollars a year on investing in myself. And I do my power hour. I take time to myself to be the best me that I can be and enhance life, et cetera, et cetera. But you got to focus on the education. So risk is one thing, educated risk is another, right? There's no guarantee in life how long we're going to live or what's going to happen tomorrow, whatever that might be, because someone could die tomorrow, right? And I've seen that happen in my own world. But investing in yourself, Shawn, it's huge. It will pay dividends, in my opinion, that are exponential. And I'm not just talking financial education. Invest in yourself spiritually, mentally, emotionally, physically. If you're someone out there that wants to drop 20 pounds, what's holding you back?
Right.
What will it take? Right? Ask yourself the question, what will it take? And then you got to discover your why, right? Start with why. You've got to discover your why. There's so many correct principles here. I love this conversation. This stuff
likewise, man.
Fired up. Yeah.
No, I love it. Well, we should definitely bring you back, Barry. This has been awesome. And you've got a message and a mission that the world needs to hear. So thank you for sharing that with us, Barry. And excited for many more years ahead for you. And I hope the book continues to do well. I think everyone, grab a copy. I think it's on Amazon and all the major book channels out there. And we'll definitely link to your website and everything in the show notes. But thank you, Barry, again for the time. A pleasure as always. And have a great day.
Thank you, Shawn.
Thanks for tuning into this episode of the Limitless Podcast. If you would like to learn more about creating financial freedom, visit us at limitlessnewconstruction.com and check out the show notes for more resources. And don't forget to show some love by liking, subscribing, and leaving a comment. Keep investing in yourself and keep living limitless.